Next question. As a part of the strategy to increase sales and profit, sales manager of a company proposes to sell goods to a group of new customers with 10% risk of non-payment. The group would require 1.5 months credit and is likely to increase sales by rupees 1 lakh per annum. Production and selling expenses amount to 80% of the sales and income tax rate is only 40%. Company's minimum required rate of return after tax is 25%. First question, should the sales manager proposal be accepted? And then second part of the question is given, which I would like to read later on. Please go through the question up to the first part. Let us have understanding of the question. The question says that as a part of the strategy to increase sales and the profit, sales manager of a company proposes to sell goods to a group of new customer with 10% risk of non-payment. So we have been provided with the simple information. Percentage of the bad debts is 10%. The group would require 1.5 months credit. So average collection period is provided to us. It is 1.5 month and is likely to increase sales by rupees 1 lakh. So sales will increase if at all we sell goods to this new group of the customers by an amount of rupees 1 lakh. Production and selling expenses amount to 80% of the sales. Production and selling expenses are given. It is 80% of the revenue. Income tax rate, so that is the new information provided to us, not provided so far to us. And company's minimum required rate of return 25%. So cost of capital is given after tax. It is 25%. So the first part of the question says that you are required to decide whether you should accept the sales manager proposal or not. Dear students, over here, the first thing that I would like to tell you is that say be little bit careful or have some common sense to be applied. The average collection period in this question, it has been provided to us in months term. So when we compute the carrying cost in the division, we will take 12 months. Okay, that is what you have to apply common sense for doing answer. Second thing that say average collection period may be provided to us in terms of number of days. If it is provided in terms of number of days, then you have to see whether the question is providing 360 days. Yes, 360 days to be taken for calculating carrying cost. If yes, take 360 days. Otherwise, my suggestion is to always take 365 days. And it may happen that the collection period is provided in terms of number of weeks. Then in that case, we'll take 52 weeks in a year for calculation of the carrying cost. Okay, this is a general instruction. I want you to write answer in the chat box that this question can be solved by how many methods? 1, 2, 3. By how many methods it can be solved? Friends, this question can be solved only by second method. Neither first method is possible nor third method is possible. Why first method is not possible? Because you can see that the question does not provide the existing sales. The question only provides that what is the amount by which the sales is going to increase. So since the first that is existing sales information is not given, so the first method is not possible to be followed. Third method, again no. What is reason? The reason for that is very simple. We understand that whatever the existing sales that we have, what is that we don't know, but that existing sales is going to increase by an amount of 1 lakh if at all we sell goods to this customer. That is the reason Adopting third method is also not possible. So we are only left with the second method, that is incremental approach for the purpose of doing answer. That is the first explanation. Dear students, one more question to all of you. Do we have sufficient information to bifurcate cost with respect to this customer into variable and fixed? I repeat my question. My question is, do we have the sufficient information to bifurcate the total cost with respect to this customer into variable and fixed? The answer is again no. We don't have sufficient information. We have only been provided that the production and selling expenses are 80% of the revenue. Out of that 80%, what is the variable component and what is the fixed component, we do not know. But we do not require even that. Why? Because we are just interested to know, let's say, what is the cost with respect to this customer to whom we sell the goods. What is the cost with respect to this customer to whom we sell the goods? That is the reason, so the information is not required. What is the variable component and fixed component? So usually in case of incremental approach, we have 4 steps, but over here, first and second step can be combined into the total cost. I request all of you to write down answer. First point. In this question, existing sales information have not been given, so we cannot use method number 1. Second, third method, total relevant cost approach. Can also not be adopted because by selling goods to new customer, sales will increase by rupees 1 lakh. Third point, we can adopt only incremental approach for decision making. Full stop. Further in that, write down sufficient information have not been given to compute variable and fixed cost. Full stop. However, that bifurcation is not required. Full stop. Now heading right down. Incremental approach. Step number 1, calculation of total production and selling expenses. In that write down, sales into 80%. What is the value of the sales? It is 1 lakh into 80%. That comes to 80,000. Step number 2, calculation of carrying cost. Before we proceed further, I just want you to write in the chat box what would be the amount of investment. What would be the amount of investment if we sell goods to this customer? Dear students over here, let us understand and say how do we compute the carrying cost. It is the total cost, total production and selling expenses divided by 12 months into average collection period. So 80,000 divided by 12 months into average collection period is 1.5 month. That comes to 10,000 multiplied with the cost of capital, which is provided 25%. So rupees 2,500 is the carrying cost. And understand friends that this 10,000 is considered to be the investment. If at all we sell goods to this customer, then in that case we are required to invest an amount of 10,000. This 10,000 rupees could have been invested somewhere else and we could have generated a return at the rate of 25%. This is the way we make the calculation of the carrying cost. It is 10,000 into 25%, that comes to 2,500. Giving once again explanation, 80,000 is the yearly cost. We understand that say when we divide the same with 12, we get monthly cost and we assume that so the expenses are evenly spread throughout the year. So it is 80,000 divided by 12. So this is 1 month cost. This customer requires a credit period of 1.5 months. So into 1.5. So this is what's the amount that say we are going to invest say for that customer, which could have been invested somewhere else at 25% and opportunity cost is 2,500. Step number 3. Calculation of the profit or loss. Let us see that say how to make the calculation of the profit or loss.